with Conduct Standard 4 of 2020. I also just wanted to, I think yesterday I may not have introduced myself, so for those of you who don't know me, I'm Zarina Kamruddin. I'm the Head of Fund Governance and Trustee Conduct in the Retirement Funds Supervision Division. And I hope that today it will be as riveting a session as it was yesterday, and that you will thoroughly enjoy it. Just a couple of other aspects for those of you who had not joined us yesterday. So just to have some understanding of the aim of this trustee training workshops, and actually the trustee training toolkit, maybe we should start there. It is to better equip trustees to exercise their fiduciary duties. And this particular training that we're running over a 4-day period is to essentially orientate you to the new trustee training toolkit that will be rolled out next year in 2023. The first 11 modules will be rolled out. So this aims to sensitize you and orientate you to the body of knowledge, which will form the basis of the questions that will be asked in your in the formative and summative assessments. So I think that it will be quite useful if you attend these workshops, as I think then you won't feel that it's completely overwhelming by the time that you do it next year. Just some other facts to consider, and which comprises some of the frequently asked questions. Since we're having the new trustee training toolkit that will roll out next year, are trustees still required to do the current trustee toolkit? And the short answer is yes, because the current trustee toolkit is extant until such time as the new trustee toolkit is rolled out, and then you wouldn't have to obviously do both. And a further question, I think that has arisen many times, is that if we've done the current trustee toolkit, do we have to do the new trustee toolkit? And the short answer is yes, because in terms of Section 7A3B of the Pension Funds Act, remember that you'll have to continue to keep up to date with the with whatever training requirements is prescribed, and this is one such training requirement. Yes, so I think for today's workshop, we have the pleasure of having as the presenter Tebogo Ramushu, who will be dealing with Module 6 of the Trustee Training Toolkit, and that deals with contributions. So as you may know, that deals with Section 13A of the Pension Funds Act, the payment of contributions, currently Regulation 33. Of course, now we also have Conduct Standard 1 of 2022, and that will also be dealt with the duties of the board in relation to the payment of contribution or the collection of contributions, criminal liability when there's non-payment of contributions, and Tebogo will also deal with contribution holidays. We also have the pleasure of again welcoming Takalani Lukhaimane as the moderator for this session. And this session will basically start at 9:15 and run until 10:25. We will allow, 10 minutes, if not 15 minutes for questions, but please also feel free as we go along to just type your questions in the chat box, and we will try to attend to it there as well. From 10:25 to 11:30, we will have Zaakir Enoos presenting on the types of benefits. So in other words, your retirement benefits, your pension provident fund benefits, your withdrawal benefits, death benefits, and disability benefits. And again, we have the pleasure of welcoming, and I say again, for those of you who attended, you know that Tando presented yesterday, but he will be the moderator for today. So colleagues, thank you very much for attending day 2 of this session. To the trustees and the principal officers, I hope that it's an informative session, and we also value your feedback in this regard. And on that note, I'll hand over to Ms. Sanchia Pietri for a few housekeeping words from her side. Thank you.
Thank you, Zarina, and good morning, everyone. My name is Sancha Pitri, and I am from the Retirement Fund Governance and Trustee Conduct Department at the FSCA. I will be facilitating the next 3 workshops. I just want to go through a few housekeeping rules. I've disabled all the mics and cameras for attendees, except for the organizers. They will still have access to their mics and cameras. If you have a burning question which you would like addressed in this session, please raise your hand and I will enable your mic and you'll be able to pose that question to the presenter or the moderator. If you would like to pop your questions in the chat box, please do so. My colleagues have been answering the questions in the chat box. If your question is not attended to, please don't stress. I am compiling a question bank, which will be available with the presentations and the recordings at the end of all the workshops. Regarding the invitations for the next 2 days, which is day 3 and 4, I think you've noted that I didn't invite anyone with the meeting invitation. I sent out a bulk email with the links. The reason for that is because, I've been experiencing technical difficulties with having so many emails in a meeting invitation. I've sent to 800 to almost 1,000 people. So, just to mitigate that, I've sent out a bulk email. However, if you are like me and you tend to forget about anything that's not in your diary, you can send me an email. I'll just pop my email in the chat box. You can send me an email, just say, hi, Sancha, please add me to day 3 or please add me to day 4, and I will do so. I see there are 182 attendees. I think that will cause a lot less friction than having over 1,000 people invited in my meeting invitation. So please let me know if you would like me to add you. I would just like to reiterate that these sessions are not mandatory, please. Don't stress if you've missed one. We will, as I've said, we are recording these sessions and they will be made available at the end of all the workshops. Without further ado, I would like to introduce my first presenter, Mr. Tebogo Ramushu. He will be covering Module 6, Contributions, and his moderator, Ms. Takalani Lukhaimane. Tebogo, I hand over to you and I will be sharing your slides for you. Thank you.
Good morning. I see Tebogo is on now. Thank you everyone so much for joining us today. Tebogo has been dealing with Section 13As for the longest time, so I actually don't think I would be doing a lot of moderating this morning. But yeah, I will take over to Tebogo. Thank you.
Thank you, Taki and Sanchia. Morning, everyone. My name is Tebogo Ramushu from the Retirement Fund Conduct Supervision Division. As Taki has already said, I will be taking you through I think it's Module 4 of the Trustee Toolkit, which deals basically with contributions. As a way of introduction, the contents of the module will basically have concentrate on the introduction, non-payments of contributions, Section 13 of the Pension Funds Act, which deals with criminal liability, responsibility of the Board of Trustees, and contribution auditing. Next slide, Sancha. As a way of introduction, I think we all know that retirement funds contributions are typically divided into employer and employee contributions. And the such contributions are deducted from the member's salary and are paid over to the fund in which the employer participates. And Section 13A places a very huge responsibility on the employer to ensure that such contributions are paid to the fund as per the rules of that particular fund that the employer participates in. And the rates and frequency of contributions are provided for in the rules of the fund. And that is provided for in Regulation 32G, which provides that the rules of the fund must entail the calculation and payment of contributions payable to the pension fund. With regards to monitoring, the Act provides that the monitoring and compliance of Section 13A will either be done by the principal officer or the authorized person, and that person shall report any non-compliance to the board in writing. If you look at Section 13A6, it gives an indication of who the authorized person is, because I think we've noted that funds have as the default, felt that maybe the principal officer is the authorized person or the monitoring person. But in truth, the fund must appoint that particular person, and the identity of that person must be reported to the authority in writing. So I'll urge the trustees that are present today to ensure that whenever they appoint that particular person, they need to make sure that the authority is made aware of that. Next slide, Sanchia. So with regards to payment of contributions, such payments must be accompanied by the minimum information that relates to that particular contributions. That information is very crucial because it will allow the administrator to make sure that they allocate the particular contributions to the relevant members of the fund that have been provided to the administrator. And that information is very crucial in that, as soon as the contributions are allocated, the funds can be invested on behalf of that particular member, respectively. And the minimum information that is provided for in Regulation 33 must be, in Section 13A, must be provided either on the day of payment of the contributions or alternatively on the 15th day after the end of the month in respect of which payments was made. So I've given an example, below there. So if contributions are paid for September, paid on the 1st of October, that information can accompany those contributions on that very same day that the contributions are paid, or they can be submitted on the 15th of October. That is the 15th day of that end of the month. So it's quite crucial that we ensure as trustees that any contributions that are paid, that they are accompanied by the minimum information, so that we don't see funds that are sitting with unallocated assets. We've had issues where the auditors are reporting to us to say that funds are sitting with huge amounts of money that have been unallocated, and it's basically through the fact that employers are not submitting the minimum information. So we need to make sure that when employers are paying contributions over to the fund, that they do make sure that they do submit that minimum information to allow the administrator to allocate those contributions that are paid into the fund. So Section 13A places a responsibility on the employer to provide such minimum information, and we want to assure the funds that failure to do that may attract penalties in terms of Section 37(1)A of the PFA. And throughout the years, this has not been dealt with properly. So we've decided as the conduct supervision division that we'll take up that responsibility to make sure that if funds do not provide that information, then we can take action against the employer that are not providing that particular information. So we've tried to have a process in place where we can assist funds where employers are not providing that particular information, so that we can write to the employers to say that if you don't provide that information as required in terms of the Act, we'll issue penalties in that regard. And I think the penalty is about $1,000, for every day that information is not provided to the administrator. And I think you might have noted, or you might have noticed that we've issued a conduct standard 1 of 2022, which has made changes to the minimum information that should be provided by the employer. And if you look at the next slide, Essentia, we've made sure that we give an indication of the information that has been added in the conduct standard. So all information in red, the information that has not been there or provided for in regulation 33 before. So we urge the funds to make sure that at least from now they prepare themselves for when the conduct standard are going to be in operation. That you start by at least notifying your employers that this information will be required as we go forward. So start preparing now so that when the conduct standard is issued, that at least your participating employers are well aware of that information that should be provided to the funds. Next slide, Sanchia. In terms of Section 13A, employers are obliged by Section 13A to pay contribution to the funds they participate in terms of the rules of their rules in full. So what this says is that we cannot, see a situation where we only receive contributions on behalf of members, but the employer doesn't provide contributions or that they should be paying over to the fund, or where employers are deducting and they don't pay over to the fund. So we've noted that since the pandemic, we've seen instances where either contributions are not paid over to the fund, or funds are receiving less contributions that are paid, not in terms of the rules of the fund. So we also urge, board members to ensure that contributions are paid in full. And Section 13A3 provides direction on how such should be made and dates by which those contributions must be made. So I've provided, an example underneath. So as you know, we've got two types of funds. We've got private funds and we've got those that are underrated. So those that are administered by insurers. So with regards to 13A on private funds, those contributions might be paid over to the fund bank account, not later than 7 days after the end of the month. And for your underwritten funds that are administered by insurance, those contributions might be forwarded to the insurer concerned in such a manner as to have the insurer receive contributions not later than 7 days after the end of that month. So compliance with that particular provision has been a very big issue, and we've noted, in the past that, or even currently, that funds are reporting to us to say that they're not receiving contributions on time, or that they don't get contributions at all. So we'd urge funds to keep on reporting to us to make sure that you keep in touch with what is required in terms of the Section 13A of the Pension Funds Act. Next slide, Sanchia. So in order to persuade employers to pay contribution timelessly, Section 13A makes provision for interest to be paid on any amount that is not transmitted or received by the fund on time. So interest in terms of Section 13A7 will be levied on any amounts not paid timelessly in the fund's bank account as prescribed in Section 13.3A, or any amounts not received by the fund as prescribed in 3A2. That is what we were dealing with in the previous slide. That is payment of contribution into the fund's bank account, or those that are received by the insurers. Next slide, Sanchia. So if you look at what Regulation 33 had made provision for in the past, it made for interest to be paid on the first day of the month following expiration of the period that the said amounts were payable. So there has been a bit of a contradiction there, because if you look at Section 13A, says the interest must be calculated from the first day following the expiration of the period in which, or in respect of which, such amounts were payable. So if you look at the example that I've given there, it says contributions for September, let's say for argument's sake, were expected on or before the 7th of October. If not paid on the expected time period, interest will be calculated from the 8th, not from the 1st of October. as provided for in Regulation 33. So the wording has changed differently now in the conduct standard to align that. So I think, for funds and board of management, you need to be careful of how to calculate or when to calculate interest on late payment of contributions. Next slide, Tansha. So with regards to the calculation of that particular interest, the compound interest will be prescribed from time to time by the minister under Section 13A7 of the notice in the Gazette. So the current rate of interest in terms of the Usury Act is currently 23% in terms of amount not exceeding 10,000 and 20% on amounts exceeding 10,000. And you need to note that the conduct standard has now issued a prescribed rate as per paragraph 5.1b, which states that the prime rate, the interest will be prime rate plus 2%, and that will only come into effect 6 months after the date of publication. So to the board of management and the administrators, this is quite crucial that you also note that, and you make sure that the interest is calculated properly. So interest that is calculated on late payment of contributions shall constitute investment income for the fund and shall be payable to the fund by no later than the end of the second month following the month in respect of which the amount is received. I don't think this particular matter has been dealt with, properly. So we note that in most instances when we receive reports from administrators of funds with regards to non-payment of contributions, we're not even sure that this is complied with, where interest or late payment interest are paid over to the fund. And we note at times that interest is accumulated because employers are not paying. So you find that employers are 3 months in arrears, and you keep on calculating interest upon interest and upon interest, and that creates a bit of a problem. So we'd urge funds and board of management to ensure that as soon as payment is received on late payment of interest, that amount is paid on time as per the Pension Funds Act. Next slide, Sanchia. So compliance with monitoring of Section 13A, as I alluded initially, it's either by the principal officer of the fund or any authorized person. And that particular person is required to submit reports to the category of persons who have interest in such compliance. Meaning that if should there be any non-compliance with Section 13A, members of the fund have to be notified of that particular non-compliance. And throughout my experience, especially when we do on-sites, we've noted that there are different avenues that are taken by the funds in terms of reporting to members of the fund. Some are using SMSs, and at times with regards to those SMSs, it might be that a member has lost their number or they don't use that number anymore. So the biggest question that we ask is how sure are you that these members that are affected by the non-compliance have received that particular communication? It's one of the topics that we've really how can I put it? We've really struggled with in terms of determining whether these members do receive the notification that contribution has not been paid over to the fund. And I think I've heard yesterday where some of the board members were saying, but what would be the best way to communicate with members of the fund? And I think it's something that the board must decide on, and you profile the type of members that you have in your fund. That will give you an indication of how best to communicate with those particular members. If you look at paragraph 4.2 of the conduct standard, it makes provision on how the report should be made. It says the monitoring person must report to the board in writing on any non-compliance with the provision of Section 13A2, and 3, within 7 days after receipt of the report from the person responsible for receiving contributions. That means you'll have someone from the administrator that receive contributions on behalf of the fund. And as soon as that person doesn't receive those contributions, they need to report to the monitoring person, and that person must report to the board within 7 days after receipt of that particular report from the person receiving those contributions. So I think it's quite crucial that the board of management make sure that person reports as per the requirements of section 13A2 and 3, that they do get the reports on time as provided for in section 13A. Furthermore, paragraph 4.3 of the conduct standard also makes provision that the monitoring person must also bring the non-compliance to the attention of the affected members of the fund and the authority. Please note that, and the authority within 30 days from the date of the board that the board was informed. So as I said earlier, we are receiving reports, and thank you for the funds that are really providing those reports to us. And we'll urge, funds that are not reporting to start reporting to us, so that we know and understand, the nature of the non-compliance that the funds are sitting with, so that we can be able to assist on our side in terms of compliance with section 13A on the errand employers. Paragraph 4.4 of the conduct standards also provide that if a non-compliance continues for the period of 90 days, the monitoring person must report the matter in detail within 14 days of the expiration of such 90-day period, and also report to the SAPS and inform the authority accordingly. Yesterday again, I think we've heard complaints from some of the trustees that they don't get joy when they report such matters to the SAPS or to the NPA. And I think Taki will come in here. We've had engagement with the SAPS and the NPA, and the biggest problem that we're sitting with here with the SAPS is that you'll be sitting with one person, taking them through training and explaining to them what section 13A entails and what needs to go into that compliance. And with regards to how these people are taken around, you find that you deal with one person today, and the next day that person has been transferred to another division or another province, and you find that it creates a bit of instability with regards to how to continue with that particular process. So it creates a very big problem for us as the authority. You find that someone might have an interest in dealing with the issue. 2 or 3 months down the line, that person is no longer with the SAPS, or maybe he's been transferred to another division. So it creates a bit of a problem for us, and I think for the funds as well. So we are in constant engagement with the SAPS and the NPA. And as soon as we get a good person that will be able to assist, I think we'll roll over that particular information over to the funds, and we'll assist the funds in terms of submitting those particular non-compliances. So in terms of accountability for payment of contributions, section 13A sets out the person that should be held liable for non-payment. And this is the how section 13A8 make provision. It says for a company, every director regularly involved in the management of the company's overall financial affairs. For a closed corporation, it will entail every member who controls or is regularly involved in the management of the closed corporation overall financial affairs. And for employer not described in the company or closed corporation, it will be every person according to whose direction or instructions the governing body of the employer acts or manages the employer's overall financial affairs. So in an instance where the employer does not provide the identity of that particular person, so that section 13A8 will kick in. Section 13A9A obliges a fund to request the employer in writing to notify it of the identity of such person, so personally liable in terms of section 8. When we normally receive reports from funds regarding non-compliances, this is one aspect that we also struggling with, where we know that we're not even sure whether the funds are requesting that information, or they do request and the employer are not forthcoming with that particular information. So we urge the funds to make sure that they request that information. If the employers are not forthcoming, please let us know, so that we can be able to intervene in that particular matter to assist the funds. And Section 13A(9)(b) provide that failure by the employer to comply with the requirements, as I alluded initially, that for a company, all directors will be held liable. For a CC, all members will be held liable. And you need to know too, I think you'll note it in terms of Section 37 that non-compliance with any parts of Section 13A will attract a penalty. So we'll urge funds to make sure that they request that particular information, and they notify us in time if they don't get any joy from their funds, to alleviate in instances where we might come up and issue penalties on that particular non-compliances. So Section 13A(9) ensures that there is no confusion as to who should be held liable for the employer's failure to pay contribution to the fund. I think that is clear in terms of Section 13A(9), that if the employers are not providing that particular information as required in subsection 8, that everyone will be held personally liable. And when it comes to responsibilities of the Board of Trustees, if you look at Section 7D(1)(b), it places a responsibility on the board to ensure that there are proper systems in place and that are employed by an employer, that are employed by the fund, and that is by ensuring that the administrator that is appointed to administer the fund has capacity and resources to collect contributions timelessly. So as a responsibility on the board, you need to make sure that when you appoint an administrator, especially for a fund that has got a lot of members or participating employers, you need to make sure that that particular administrator has got capacity and resources, whereby you don't sit with an instances where employers are paying and administrators are only allocating and investing not in terms of the agreement that has been signed with the fund. So it's a huge responsibility on the board to make sure that they do that. And again, Section 7D(1)(d) also places a responsibility or duty on the board to ensure that contributions are paid timelessly to the fund in accordance with PFA. So we know that the board are appointing appointing a monitoring person, authorized persons, to make sure that contributions are paid timelessly. But that responsibility lies ultimately with the board to ensure that those contributions are paid timelessly. And the board must ensure that the monitoring person fulfills their responsibilities as required in the Pension Funds Act. And they need to also make sure that appropriate action is taken against errant employers. So when we receive reports, the standard reports that we issue to the funds will have a place where you need to ensure that you notify us as to what action has been taken. Did you report to the South African Police Services? Did you report to the NPA, or did you report to the Pension Funds Adjudicator? So there has to be action that is taken by the Board of Management. You cannot just issue letters to the employer and not take any action. So you need to make sure that action is taken, so that when you report to us, when we request that particular information, you are able to demonstrate to us that you have taken proper action to ensure that any error contributions are collected. So with regards to contribution holidays and just touching on area contributions, this is one aspect that we've been dealing with internally as the authority. We know that there are instances where employers are unable to pay contributions and they keep on not being able to pay, and the funds we know that the funds are not, or the board are not assisting them in terms of making sure that they don't accumulate a lot of area contributions and interest. So I think the biggest question, especially from the board of management, is that what other avenues have the board taken to ensure that they assist employers that are errant, to ensure that they don't accumulate a lot of contributions. I know for sector funds it might be a bit of a problem because they participate in the funds in terms of the sectoral determinations, and it's not easy for them to have a rule that make provision for paid up funds. But for funds that are private, maybe that the question might be posed to the board of management to say, but if you see that this employer is struggling, and if they come forth and explain to you that we're struggling with regards to payment of contributions, what measures have you taken to ensure that you assist these employers to alleviate them having a lot of amounts that they won't be able to pay in the future? So I think that's one thing that maybe the board of management must keep in mind. So with regards to contribution holiday, section 15A1 provides that all actuarial surplus belongs to the fund. So with regards to contribution holiday as defined in the PFA, it says for a DB fund or defined benefit fund, it means payment of less than the contribution rate that the evaluator recommends be payable by the employer, considering the circumstances of the fund and including any surplus deficit. So that means in this particular fund, the evaluator will recommend whether the employer might take a contribution holiday. And for a DC fund, means payment of less than the employer contribution rate defined in the rules of prior to application of any credit balance in an employer reserve account as defined in the rules of or employer surplus account. So in terms of section 15E, a participating employer may require the board to use actuarial surplus if there's any allocated to that particular employer surplus account in terms of section 15B, C, and F for the use by the employer for funding a contribution holiday. So employer cannot just take a contribution holiday. So if they've got any amounts allocated in that particular employer surplus account, then that employer can request or request the board to use that particular amount that are allocated to ensure that they take a contribution holiday. So no employer can just take a contribution holiday without having the resources to do so. And ladies and gentlemen, I think that's my story for today. I think we'll allow questions with regards to what has been presented today.
Thank you, Tebogo, for that insightful presentation. Area contributions is such a big issue in our industry. So I just want to thank you for the updated information on Section 13A and also for providing clarity with your examples. We'll be taking questions now. So if you could please raise your hand if you have a question for Tebogo on his presentation or his moderator, Mr. Takalani Lukhaimane. Let me just check.
There's been so many questions in the chat. So yeah, I think Zarina and I have attended to quite a few now already in the chat.
Thank you, Taki and Zarina. I see we have a hand, so I'm just going to enable Patrick's mic. Patrick, you can unmute yourself. Hi, Patrick, you can unmute yourself.
I'm just struggling a bit.
There we go, we can hear you. Oh no, it's gone again. Okay, while Patrick sorts out his mic, I'm going to enable Johan's mic. Johan, please unmute yourself. Johan, I've enabled your mic. Please unmute yourself. So I think Johan and Patrick might be having some technical difficulties.
Hello, hi, good morning. Can you hear me?
Hi, Patrick. Yes, we can hear you.
Oh, thanks. Thanks for the opportunity. Yeah, I just wanted to ask. I missed that where they say where they explain that the employer will be penalized. I don't know if they said 100 rands a day or 100, that 100,000
It's basically 1,000 and a day.
or 1,000 rands a day.
Yes.
Oh, okay, all right. Thanks. No, I just wanted to ask that. Thanks.
Thank you, Patrick. Johan, you can unmute yourself. I think Johan might be struggling a bit, so I will just go to Justice and then Angie. Justice, you can unmute yourself. Justice Shakwane, you can unmute yourself. There you go.
Yes. Good morning. Can you hear me now, Sanche?
Yes, I can hear you perfectly.
Yes. Good morning, everyone. I just want to ask a question because I joined you guys late. My question is pertaining to the contributions holiday. When did the employer qualify to get contributions holiday? Thank you.
Thank you, Justice, for that question. Taki, see Taki is ready to answer.
Yeah, I think I'll answer together with Tebogo though, but the employer could have been allocated, and in the employer surplus account could have been allocated surplus from initially the surplus apportionment scheme in terms of 15B, or it could have been future surplus as well. So from there, if the employer says, I would like to take a contribution holiday, and I would like to use the amount in the contribution in the employer surplus account to do that, the Act actually does set out that the employer can use the employer surplus or employer surplus account for the contribution holiday. So it's not a matter of when did they qualify, it's whether they are able to, if they have money in the employer surplus account, and it is actually approved in terms of the rules that they can do that, and they've set it out in, and the Act does permit for it in any event, then they would be able to do that.
Thank you, Taki.
All right,
Just
thank
answer
you.
Are you
the question.
covered? Justice, are you covered? Are you happy with the response?
Yes, I'm happy. Yes,
Okay,
I'm
thank
happy,
you.
Sanche.
Thank you so much. Okay, I will then take Angie, Mungezi, and then Tertia. Angie, I've enabled your mic. You can please unmute yourself.
Thank you very much. Good morning, everyone. And once more again, thank you for the good presentation that you made. I just want to have more clarity around the question of subs 90 days while you are going to inform the authorities. Do you go to which side of the law? Because you'll go to the police station perhaps without the knowledge, and you'll find that those who are also in there, they don't know what to understand. If we can just be clarified as to which subs department do we go at. Thank you very much.
The SAPS issue and the NPA issue is one that we are trying to resolve, and I know it was addressed by our divisional executive as well at the IRFA conference. It is a very frustrating situation for the funds. I saw most of the queries or the questions in the chat related to, why refer or make it something that SAPS needs to deal with if they're not equipped to deal with it, or they aren't doing anything about it. the simple answer is it is a criminal offense, right? For you to be deducting contributions, it's fraud. It's actually a criminal offense, and we as the Financial Sector Conduct Authority are not prosecutors of criminal offenses. And so it does need to be referred to them. It is a statutory offense. And, you know, we've had meetings we recently had a meeting with the Bargaining Council, and they said, you know, it used to work quite well, even previously as a deterrent. I'm not going to say which Bargaining Council now, but I think they know, they know who they are. And it used to work quite well even before, and employers knew that if they contravened, then there was going to be action taken against them. I think our challenge at the moment is to make sure that we close the gap on the awareness on SAPS, the NPA, and even in the magistrate. So we're looking at a few options on what we can do. And we're hoping that we will be able to, and it was always our intention, Angie, to give you where you need to go. And to make things easier, you'll see the conduct standard refers to forms that can be filled by a fund. Those forms, one of them is the notification to SAPS. And on that notification, we actually worked with the SAPS to create it as closely as possible to the A1 statement that they have, where they were noting what the crime is. So it in that step as well, in reporting, it will be easier. One of the other bargaining councils also then suggested that perhaps we need to make sure that we also have a criminal code for it, so that when you go report, it's not something that the police need to still think about what is this crime. That it's already got a code, you can refer to it, you're filling out the form, you're giving them the information, and you can. And so we really appreciate all of the suggestions and all of the information that's being provided. And we're continuing with engagements on the Section 13As as well. We're doing webinars. We had one for municipal funds, and the next one will be bargaining councils, and then we'll do commercial umbrellas early next year. So I'm hoping that at the end of all of that, we will have solutions not only for the industry, but also bespoke ones for different types of funds, so that we can also regulate fit for purpose. And I think we've made strides in that as well. An example would be where bargaining councils can't have contributions by the 7th, there are exemptions for that. You know, they can get an exemption from the 7-day period. So there is already some accommodation for different types of funds. I think we just need to improve and progress on that as well to make sure that everyone is accommodated. I hope that answers the question in a roundabout way.
It extended the answer. Thank you very much, Taki.
I'm hoping to have also dealt with the 3 other questions that are coming up with the SAPS and the NPA issue. It really isn't something that we want to see happening. And believe me, I just don't want to. I don't want to again say this is what we're doing, and then someone says that's what you said last time. So I'm keeping it until you see something. But believe me, we are really definitely working on it.
Thank you so much, Taki. I've allowed Mongezi's mic. You can unmute yourself. Mongezi.
Hello, everybody.
Oh, hi. There we go. Hi, good morning.
Morning. No, it's just a follow-up question on a question that I had put through earlier on our Q&A. And just in a hypothetical situation that a fund has got a rate that is higher than the prescribed rate, right? What should the fund necessarily do? Must it lower its rate back to the prescribed rate, or can it continue with the rate that it has already prescribed for itself?
So hi Mongezi, how are you?
I'm good, thanks. Takalani.
Good. Yeah, as I said in the chat, it's a prescribed rate, so that means you have to stick to the one that is there. It shouldn't be higher than the one that is in the act. Otherwise, the fund or the employer can always come back and say the fund is actually not complying with the law in that it's got a rate that is higher. So it's not a minimum rate. It is the rate.
Thank you so much. That covers it.
Thank you, Mungezi.
Thank you.
Has Patrick been able to ask his questions, Sancha?
I'm going to go back to him.
All right.
I hope his issues have been sorted. Let me see. Patrick, can you unmute yourself, please? Patrick? I think he's still having technical issues.
Perhaps
So
we can go to Tertia.
Yes, I'm going
Yeah.
to go to Tertia. Tertia, you can unmute yourself.
Thank you. Good morning. I just want to ask the question regarding the Section 13A. You did see my response yesterday. I just want to know, what do we do in the meantime when we try to report to SOPs but could not register the case to get a case number? What now? Do I report it to the FSCA or whatever? What should I do now?
Okay,
I can't proceed now. And the liquidator can also not proceed because the liquidator needs this case number to be able to submit the liquidation to the FSCA for approval.
Okay. Tertia, can you please, because in any event, the Act also does require that it be reported to us. But our investigations department is in contact with SAPS and the NPA to try and make sure that we do coordinate the cases and difficulties that we're experiencing. So please, can you send that through to me? I will just put my email address in the chat. Please send it through to me so that we can see that we coordinate for you to be able to open your case at the police station or within the special commercial crimes unit within your jurisdiction so that you're able to proceed. And then we can see how to take it from there. Is that okay?
Yes, fine, thank you.
Okay, not a problem.
Okay, thank you, Tertia. Next, I'm going to allow Johan's mic and then Nadesan, Governor. Johan, can you please unmute yourself? Johan, kindly unmute yourself. Okay, I think Johan is also having technical difficulties. So let me go to Nadesan, Governor. Could you please unmute yourself? I hope I'm saying it correctly. Nadesan. I'm not sure. Oh, okay, no. Put his hand down. So let me go back to Patrick. Patrick, could you please unmute yourself?
Apologies, I forgot to drop my hand. sorry about that.
And did you see how excited we got? Like, yay, he's on now. And then
No, that's okay. That's okay, Patrick. Okay, I'll just okay, so I think it's Mr. Governor. You can unmute yourself.
Yes, good morning. Yes, thank you very much for the presentation. I'm just checking because if you have a fund where the bargaining council is, the contributions are actually channeled by the bargaining council. Yes, we note there may be trustees and it's the ultimate responsibility of trustees to enforce compliance. But when bargaining councils have a compliance department, how would that effect because they are the ones that would first have sites that they no contribution by the employer, and then how do we deal with that issue, because it becomes a challenge when you duplicate the process. So I'm just seeking some clarity. Thank you very much.
Okay, thank you so much for the question, Mr. Govender. I think, you know, through our interactions with the Bargaining Council funds in preparation for the Section 13A webinar, you know, it's come up a few times that the bargaining councils have got this compliance sort of department within. We don't see that as a conflict in terms of timelines. Remember, the fund can well employ or outsource or contract someone to do compliance and to also recover contributions and to do even the monitoring that Tebogo highlighted earlier to do compliance. So it's not that we see it as that it's outside the process. It's actually part of the fund's process. So the challenge is that the fund must then set out its Section 13A process to clearly determine who is doing what so that you are able to comply with the Act. But we don't want you to necessarily drop all of these other processes and see the Bargaining Council as someone who's interfering or a part that is not part of the Act. Bargaining councils have for years had their own processes and have for years employed those processes to be able to run in a manner that is you know, conducive to their own environment. So we wouldn't want to then have it be as though we're clashing with the bargaining councils. We want you to find a way to make it that you are using those processes to strengthen your compliance measures. So it's not, you know, you shouldn't see it as a separate they are. It should be that the fund is trying to find a way to leverage off of that, to be able to make compliance easier and better for the members as well.
Thank you so much, Taki. Mr. Govender, are you covered? Yes, thank you. Okay, Tersha's hand is still up. I'm not sure if it's a follow-up question. Oh, she has removed it.
Mugesi's hand is also still up.
Yes, I think I'll just remove it for him because he did say he was struggling. Okay, that's fine. And then, are there any other questions? Oh, let me move up. Presenters. Zarina, I note your hand. Please go ahead.
Thanks very much. I was just wondering, so, and you know, please bear with me if it was already covered and everyone is clear on it. But a question that has come up and we've received many queries on is, you know, what happens between the Reg 33 now, since we have Conduct Standard 1 of 2022. So I think maybe if Tebogo or Takalani, if you wish to address that, that might also be useful. Because I think some people see it that we've now basically said that Reg 33 no longer applies because Conduct Standard 1 comes into effect. But I think some entities or persons view it as a lacuna because they're saying that the conduct standard only takes effect, you know, during the course of next year. So can you maybe address that, Takalani or Tebogo?
I'm going to ask Tebogo if he wants to, but from our side, Regulation 33 is still in effect until the conduct standard comes in, which is 6 months down the line, which is, I believe, the 19th of February next year. You know, we're still then also making sure that the forms also come into effect, and we'll be issuing those for comments soon. But the regulations are still applicable until the conduct standard is in effect 6 months from approval, which was in August already. Yeah, thank you.
Just to add on what you just said, Taki, if you look at the presentation, I think we made that fact that some of those provisions will only come into effect 6 months after the date of application. So you're right. The regulation that it is still in effect.
Thank you, Tebogo and Takalani. I've received an email from Lazan. She can't she can't raise her hand. Lazan, I've allowed your mic. If you can unmute yourself, please. Lazan, you can unmute yourself. I think she might be struggling with technical difficulties. Let me see. I don't see any more hands. So I think we can move on, if that's okay with everyone.
Fine with us. Sancha, thank you very, very much. And Deborah, thank you so much for the presentation. We really appreciate the comments that you've made because they always inform us, making sure that we can meet you at a practical level as well and operational. So thank you very much for your participation. It's much appreciated.
Thank you, Takalani, and thank you, Tebogo. Let me hand over to my next presenter, Zaakir Enoos. He will be covering module 11, types of benefits, and his moderator is Tando Mbono. I will be sharing the slides.
Thank you, Sanjay. Good morning, ladies and gentlemen, board members and colleagues. The next presentation has already been said is by Mr. Zaakir Enoos, who's a senior specialist, or rather specialist analyst, I'm sorry, at the Retirement Fund Division Supervision. He will be talking to us on the topic. Zaakir is a valued colleague of ours who has the issues at his fingertips. So we are looking forward to a great presentation by Zaakir. Zaakir, take it away, please.
Sure. Thanks so much, Tando. Good morning, colleagues. Good morning, everyone on the line. And thanks for allowing me to present today. I'll put off my camera. You can see this is me, Zaakir Enoos, as Tando said, specialist analyst in the Retirement Fund Conduct Supervision. And I see a few names that I'm familiar with, and welcome and nice to see your name again. I'll put off my camera just for bandwidth purposes, but we'll jump straight into it. So Sancho, you can move to the next slide. For today, I'll be covering types of benefits, and the content is merely just introduction, what the retirement benefit, a withdrawal benefit, a disability, a death benefit, and a disability. Again, at this point, just to point out that there is a specific module that will deal with Section 37C and the distribution or distribution, and there is a specific module on default regulation. So I won't go into detail on that. The purpose of this presentation is merely to introduce the different types of benefits. So just from an introduction perspective, Section 1 of the Pension Fund Act provides for a definition of pension fund organization, which is also a pension fund. And in this definition, it's not only pension funds, it's also provident funds. The crux of the definition talks to a pension fund being established for the payment of annuities or lump sum payments as its primary objective. But as we'll recall, or as you will know, there's different types of other benefits that's also available at various circumstances during a member's life in the fund. And so we'll talk to retirement benefits being the primary one, and then withdrawal benefits, death benefits, and disability benefits. Sancha, next slide. Thanks so much. So a retirement benefit, what is a retirement benefit? So a retirement benefit is payable when a member reaches retirement age, or what we call normal retirement age, and decides to access his or her benefit. So some people always wonder, what is retirement age? There isn't a fixed retirement age, or they can go cross-sectional. You'll find your retirement age in the fund's rules, and it varies from fund to fund. And this is a link to your employment contract, actually. And in the main, retirement funds range from 60 Most commonly we see 60, 63, and 65 years of age, but it doesn't mean it can't be 61, 62, or even higher. Importantly, the Income Tax Act sets a statutory minimum early retirement age of 55, meaning the earliest a person can retire is age 55. If you leave a fund before 55, then you will be a withdrawal. There are exceptions to this early retirement age, and these include retirement due to sickness, accident, injury, or incapacity through infirmity of the mind and body, and disability will be discussed later on. Next slide, Sancha. So we're talking about, okay, there's a retirement benefit. We all would have heard the noise. We will all be familiar with the term compulsory annuitization or annuities or T-Day. And prior to the Taxation Laws Amendment Act 23 of 2020, there was a distinct difference between what a pension fund is and a provident fund. And I'm sure Julia dealt with this yesterday. But just the distinction lies in the options available at retirement. So prior to this Taxation Law Amendment Act, pension funds up to 1/3 could be taken in cash, and the rest would need to be to buy a monthly annuity or pension. And provident funds at the time could, if they wanted to, take the entire benefit in lump sum. Not that they had to, but they could take it. They had the option. With effect 1 March 2021, when this Taxation Law Amendment Act came in, there's no longer this distinction between pension and provident fund. So we will know that funds are still called a provident fund if that was their name, but the workings of it is really, they all work the same with pension and provident funds. A pension and provident fund upon retirement will require a member to buy an annuity of not less than 2/3 of the fund credit. And with every general rule, or there's exclusions or exceptions, and there are some exceptions to this, and we'll move on to the next slide. So compulsory annuitization continues, and here we're talking about the amendments to the taxation legislation provided for exclusionary provisions for members with vested rights in the following categories. And this is straight from the legislation, which is any contributions made to a provident fund prior to 1 March, any contributions made to a provident fund by a member that was 55. So I'm sure we all heard about this 55, what happens if I'm 55? And I won't go through all the list, but you can read what the options there. I'll show the next slide, which in practice, what this all means really. Sancha, next slide. So what does it mean? In short, members who are 55 years or older on 1 March 2021 are not required to annuitize their contributions. However, transfers made on or after 1 March are subject to the compulsory annuitizations. So that is 55 years and older. The other concept is members who are younger than 55 on 1 March 2021 have the option to take all the accumulated, what they call, or we heard the term vested benefits, as a lump sum, but all contributions plus growth will be your non-vested part, which is after 1 March 2021, will be subject to annuitization. And I think this is an important number to remember, or the exception is if the non-vested amount is less than the de minimis, which is 247,500. But what we're saying here is anyone in a pension fund or provident fund on retirement, if the amount is the fund credit or member share is less than 247,500, they are able to take it in cash. Importantly, any retirement benefit as time under this de minimis amount can be taken in cash. And so now, okay, I took my say I have more than 247,500, and now I need to annuitize. So I need to take this money that I have, my fund credit, and I need to buy an annuity. So in some, again, the purpose of this presentation is not to go into annuities in depth. It's merely to scratch the surface on it. There will be in the further modules where it's dealt with in default regulations. But just simplistically, I got my 2/3 now. So okay, I need to buy an annuity or pension. So members need to choose between what we call a life or a living annuity, or a combination of both more recently. So what is a life annuity? Again, this is just in the simple a two-liner on it. There's way more to it, but a life annuity is a guaranteed insurance policy offered by a long-term insurer. So your long-term insurer, you get your Sanlam's, Old Mutual, Momentum, and the list goes on. The pension is guaranteed a pension, so a payment every month until he or she dies. The person will get a monthly amount for the rest of their life. So what happens there is, say I have R1 million in fund credit. I took that million and I went to buy a policy with the insurer, and they start paying me now 5,000 Rand a month. If I live for the next 50 years, I will get that pension. If I live for the next 20 years, I'll get that pension. But it does, if I die, it doesn't go to my beneficiaries. There are no beneficiaries. When you hand over that money, you give that money over, and then you get the right to the pensions or the monthly pensions until you die. There are bells and whistles to this, but the purpose of this presentation is not on annuities per se. So what's the difference between a life and a living? So a living annuity is an investment-linked product, meaning you take your R1 million and you go to a long-term insurer and you get an investment-linked product, meaning that R1 million then gets invested. It is still yours. It gets invested in whatever portfolios you choose, and the pensioner then can draw a pension down from that R1 million. And the range, or the statutory range, or the drawdown rate, is between 2.5 and 17.5% of that million, or that capital amount. Importantly, this annuity is not guaranteed, so the risk sits with the actual member. Meaning, so if I have that R1 million, I draw down all my money. So over 5 years, I draw that money down, and I have zero money left. Then there's no more money left. You won't have that pension for life. Then. So it's important that the right drawdown rates be used. And the other side of this is, or one of the, I guess, what people look to as positive with this thing is that should I die, if I have R1 million and say I get 2 payments or 2 years of payments, I die. That money does not go to the insurer. It is the member or the pensioner's money, and that money can go to his nominee or the person designated in writing. So there's pros and cons to both of this, and obviously when reaching retirement, it's important to get advice from a financial or certified financial advisor. And yeah, so that's your living and your life annuities. So with Regulation 39, which was part of what we colloquially call the default regulations, requires all retirement funds to have an annuity strategy for pensioners. I think the important word here is that this is not a default annuity strategy. It is an annuity strategy. There's no default in annuity strategies. And apart from the traditional annuities, what I just previously spoke about, which is life and living, the regulation also allows for pension funds, and provident funds to offer an in-fund annuity for their members on retirement. So what does this mean for the member, or how do I make it? So by example, the member reaches retirement, they need to take 2/3 in an annuity. They choose to take actually the full amount in an annuity. And they say, okay, so this fund offers what we call an in-fund annuity. So in doing that, the money won't leave the fund. The money won't get paid over to an insurer. The money won't go to anywhere. It will just be transferred into the pension account, and the fund will pay that benefit over. Again, in-fund annuities, the workings of an in-fund annuity, if the fund opted for this, will be in the rules of the fund. So every fund will be different. And it's not necessary that a fund has an in-fund living or in-fund annuity. It's just necessary that they have an annuity strategy. An annuity strategy can be that, we believe that our members, our best approach is that, okay, we have an out-of-fund annuity, meaning that once a member gets to retirement, we put forward that you can go to these products, and they can have an annuity strategy. Doesn't talk to having only one annuity or one option. It can be array. The word strategy meaning many, not just one. You just have All Mutual, or you just have Sanlam. You can have All Mutual, Sanlam, and that, and then the member can make a choice. Again, importantly, there's not a default annuity strategy. The fund merely has to have an annuity strategy. Thank you. Next slide, Sancha. Withdrawal benefit. So that was retirement. So what is a withdrawal benefit? A member in a pension or provident fund are there as a condition of their employment. So it follows that if the termination of such employment has a direct implication on the membership of the pension or provident fund. The Labour Relations Act contemplates various reasons for termination of employment, including resignation, retrenchment, among others. While both resignation and retrenchment entails the termination of service, a withdrawal benefit paid after a member resigns is taxed at a higher rate than withdrawal benefit tax as a retrenchment. So this is quite important from a tax perspective, is how you leave a fund when you withdraw. And I think the next slide will illustrate this. Next slide, Sancha. So on my left-hand side, you'll see that it says withdrawal benefit, and that's the tax table applicable when you withdraw. So when you resign from an employer, we'll be taxed on that. It's important to remember that 1 to 25,000 at 0% is an aggregate over your lifetime, and that is not every time you withdraw that you get that tax break or zero. And on the right-hand side, you can see it's much more favorable, and that would be applicable when you are retrenched or die or retire. And obviously there you can see 1 to 500,000 is tax-free. Again, that's also aggregated over your lifetime. Thanks. Next slide, Sancho. Following on from withdrawal benefits, a member's withdrawal benefit must comply with the minimum benefits legislation, which can be found in section 14A. Importantly here, I'm sure the audience all knows of what a section 14 is. That is the popular section. That's got nothing to do with section 14A. Section 14 has got to do with transfers. This is the less known one, or commonly not known, is section 14A1 of the Pension Fund Act. As I mentioned up front, this will be dealt with in a separate module where we talk about what is the minimum benefit in a fund. And then following on from section 14A, in that they talk about a minimum individual reserve. So you'd say, what is a minimum individual reserve, or how do I calculate this? And then we have section 14B that sheds light on this. And there's a formula in respect of how a minimum individual reserve is calculated. There will be a short module on this one, so I won't go into detail there. Thanks. Next slide. Withdrawal benefit options. So a member who has terminated his or her employment and has an election to make, you have an election to make, so now you're withdrawing, right? So what do I do with my money? Your options are you can preserve your benefit in the same fund, you can become paid up. That's part of the default regulation, so every fund has to allow for that. Elections to transfer his or her benefit to a pension or provident preservation fund. So that is, I'm taking my money and I want to transfer it out to another fund, but a preservation fund. The next one is I can elect to transfer to my new employer. So I'm going to go start work at the next place, and I'm merely taking it over to that occupational fund, or I can take it in cash. Importantly, so the first line there is talking to paid up. What is this paid up? So importantly, if you become a paid up member, so you preserved your money in the fund, when you got your withdrawal form, you tick paid up, or you just left it and you answered nothing, you become paid up then. So importantly here, there's no new contributions that can be made to the fund. So your money will be invested and it will grow, but you cannot add contributions to this thing. If the fund was offering risk benefits, you are not entitled to risk benefits and you don't pay the premiums thereof. If you die while your money is still in the fund as a paid up member, 37C will apply, and the member must be given what we call retirement benefit counseling. And again, we have a session on default regs and all of that, which will cover what exactly retirement benefit counseling is. So should the member not make a choice of one of the above, they will default into being a paid up member. So this is where the default regulations get some of its name is from, that this paid up provision, that you become paid up if you don't make a choice. So you don't need to, if you don't do anything, that's how it will happen. Moving on to death benefits. Again, we have a section on 37C. So I'm just going to unpack what a death benefit is or to that effect. And a death benefit is generally made up of one or two components. In the main, it's generally two. So why I say this is fund credit. So on the one side, you have a fund credit. That's the contributions less costs that go in, gets invested. And the day you die, there is a pot of money. Your fund credit, member share, that is what it is. So then some funds offer what we call approved life cover, or GLA, group life cover. And so when you die, if the rules of the fund talk to an approved cover, if there's approved cover, you will get your fund credit plus your GLA, and that will equal your death benefit. So people sometimes think that it's only the fund credit that is the death benefit. That's not right. If there's an approved cover via the fund, it's actually, there's two components to it. Importantly, as you'll recall from the previous slide, I said if you're paid up member and you die in service, you also get a death benefit. But what will happen is you'll have a fund credit in the fund, but as a paid up member, you don't have risk benefits, or you're not entitled to risk benefits and you don't pay PIM. So this group life cover for you will be zero. So you'll get your fund credit will equal your death benefit in that case. But if you're an active member or a disability member in the fund, that's the way it will go. Following on from this death benefits, I've mentioned before, where a member dies in service, a death benefit becomes payable in terms of the rules, and it falls to be distributed in terms of Section 37C of the Pension Fund Act. If a member dies after retirement, but before his benefit could be paid, the FSCA has clarified this position to be that the benefit is still payable in terms of Section 37C. On the death of a member, death benefit becomes payable to his or her dependents and or nominees, and Section 37C1 confers the discretion of the trustees on how to distribute the death benefits among the dependents or nominees. And again, that will be dealt with in the specific module for Section 37C. Moving on to disability benefits. So this is a benefit where becomes payable when a member is physically or mentally impaired, such that he or she is incapable of engaging his or her normal occupation or any other occupation for which he could be reasonably considered capable of engaging in by virtue of his qualifications, training. Look, importantly, the precise definition of disability should be, you should look to your rules or the policies that the fund signs. It varies from these different, or it varies. Next slide. Disability benefits, we're continuing. Ill health, early retirement. This can be paid to a member below the age of 55, as I said previously, within the consent of the employer. The benefit will comprise the member's fund credit and will be paid out as a retirement benefit, meaning it will have that favorable tax table. Now we get to the term that I introduced earlier, which was approved lump sum disability, or GLA. And an approved benefit is one that is provided for in the terms of the rule, in the rules of the fund. So importantly, the rules is always an important document for trustees, and they should look to the rules to see if it's an approved, if there's an approved benefit. The benefit is paid to a member if he or she is totally, and sorry, this is not GLA, this is disability, but it's generally the same amount of salary. So meaning if your group life cover is 3 times salary, if the fund has an approved lump sum disability, it will also be 3 times salary. The benefit is paid to a member if he or she is totally and permanently disabled in terms of the policy. Again, the definition of disability you must look at that. It's important. If the member meets the criteria for disability, which will be in the policy, he or she will be paid his fund credit together with a lump sum disability insurance amount. And this normally is 3 times cover, or it will be the same or aligned to the group life cover, which is also generally 3 times, or between 3 and 5 times. So this one, people oftenly mistaken to be a fund benefit. So this is an income disability benefit. It is not. This is a policy between the employer and an insurance company. It's separate from the fund. It's in the name of the employer, and it falls outside the ambit of the retirement fund. But why funds get to deal with this is because sometimes the full contribution is paid to the fund, and the fund is used what we call as a conduit for the premiums of this benefit. And importantly, the rules must make provision for this. The main thing here is, as much as the fund is involved in this, this is not a fund policy, and this benefit generally looks like is expressed as a percentage of salary, saying 75% of salary. So what this means is a member is working and he gets his salary and he becomes disabled. There's a waiting period. He waits, they do all the examinations and things, and they say, yes, he's disabled. And what this is doing is it's then paying him 75% of his salary on a monthly basis. He will get that amount. He will be called a disability member on the books of the fund, and contributions will still go to the fund. But that amount the insurer pays straight to the member or to the employer. It doesn't come to the fund. This is not a fund policy, and it's important to remember income disability, or PHI, is never or cannot be a fund-owned policy. It will always be on an unapproved basis. So this is just again, the purpose of this thing is not of this presentation is not to talk about approved, unapproved, and the intricacies of that, but just a summary of an approved and unapproved policy. On the approved side, the cover provided via a tax tax-approved retirement fund. That's where the word approved comes from. On the unapproved side is provided via a group insurance policy affected by the employer. So, and then the contracting parties on an approved cover would be the employer, retirement fund, and insurer. On the unapproved side, it's the employer and the insurer, liability and ownership. The fund is liable for payment of the benefits and owns the policy in terms of approved, and in terms of the unapproved, as I mentioned earlier, the insurer is liable for the payments of the benefit and the employer owns the policy. Unapproved, employer owned. Approved, fund owned. And then there's further benefits there, but I won't get into those. Next slide. Disability benefits and duty of the employer to notify. So where the rules of the fund provide for a disability benefit and the member becomes disabled, the employer owes at the very least a duty of good faith to the member to submit a claim on his or her behalf. If the employer fails to timelessly submit the claim to the fund and by implication to the insurer may repudiate the claim. And we've seen from the adjudicator has on occasion found that employer liability for the repudiation of a claim and ordered that the employer compensate the member. So important with disability benefits is always the notification. You need to notify as early as possible, and if claim forms are given, it needs to be channeled through to the correct people, because there are periods that, or there are strict periods with the insurer will enforce with regard to notification of the disability. My next slide, I think, is my concluding slide. Thanks so much for your time today. Hopefully I made some sense and gave some color to these types of things. Again, as I mentioned, it will be detailed in the further chapters, but this is just to give you understanding that there's not only a retirement benefit, or when you retire from a fund, there's other options when you withdraw from a fund or before the end of your before you get to retirement. There are other ways where you can leave the fund, and there's things that's applicable there. Thanks so much to everyone. I can't see questions, well, I'm not, but yeah, thanks so much, everyone.
Thank you, Zaakir.
Thank you, Zaakir. There will be questions, no doubt. Sorry, Sanshia, did I speak over you?
No problem, Tando. I just also want to say thank you for that session. You know, Zaakir, this forms part of the foundation of retirement funds. So it's always important to get the basics right. And also it's a nice introduction to the next modules that will come next week. Are there any questions? I'm not seeing any hands. So if you could please raise your hand if you have a question for Zaakir or Tando. Zarina, I note your hand, Zarina. Please go ahead.
No, I see Greg has his hand up. I was actually going to say that there's something in the chat. So I think over to him, Sancha.
Thank you, Zarina. Greg, I've enabled your mic. If you could please unmute yourself. Hi, Greg. If you could please unmute yourself. I think Greg might be struggling with a few technical
Sancha, then
issues.
perhaps read the question maybe, and so that Zaakir or Tando can address it.
Okay. Oh, I see. Here's the question. Greg, why can't income disability be a fund policy? Zaakir or Tando, would you like to address that question?
Tando, you want to go for it?
Oh, sorry. May I? Oh, sorry. Zaakir is actually
Sure.
the
No,
expert
go
in
for
these
it.
things. Must I go for it? He has
Yeah,
the
go for it.
issues on his fingertips. But remember this, Zaakir said this is a fringe benefit. It is taken by the employer on behalf of its employees to replace the income that otherwise would be paid by the employer when the member is not working. So it cannot be a fund owned. It has to be taken by the employer. So that's the reason. I hope Zaakir is got something to add there, or if the question is answered with clarity.
I'm happy. Thanks.
Thank you, Tando. Thank you, Zaakir. Ramatu also has a question. What happens when you have other retirement benefits, other than other retirement benefits other than the pension or provident fund? How is this treated when you withdraw?
I assume he's talking about the taxation thereof, or if you can just add color to that question, or Tando, unless you understand the question differently.
I don't understand. If she could just clarify as to what other implications does she have in mind, Pat?
Talking about other retirement benefits.
If
I'm
if
guessing
if
other than your
let
fund
me just take a
credit. That's how
let me just take a
I'm
step.
understanding it.
Okay, Sanchez, let
Thank
me
you,
take a
Tando.
step and see if I understand the question correctly, and then you just come in if it does not take her where she wants to go. If you are a member, for instance, of an occupational fund, right, and you resign from your employment, obviously you're entitled to a withdrawal benefit in respect of your membership in that particular fund, occupational fund. But it doesn't do anything for your retirement annuity perhaps that you may have outside, which is not a function of your employment. So it has no implication. If, for instance, you are a member, say, both of a pension and a provident fund within that same employer, and you want to resign, and you want to withdraw as opposed to be paid up, then you get both those benefits flowing from both your memberships. One does not implicate on the other. I think if that is what the question was contemplating. Thanks, Sansha.
Sure. I think, Tando, just to add to that is, obviously from a tax perspective, that I said it's cumulative or aggregated, so the tax-free part, or the 0 to 25%. It's only a once-off. You don't get that 0 to 25% every time you retire from a retirement fund. SARS keeps the information. So when you retire again, you won't fall into so say you take 25,000 the first time from your pension fund, and you move to another fund, and you now take another 25,000. That second 25,000 from Fund B will be taxed in the second bracket. It won't. Sanjay, if you want to go to that slide, sorry, just where the tax tables are. I think it's, if you can. Sure.
Go there now. There we go.
Sure. So the first time you retire, you'll get that amount tax-free, and then the second time you will actually fall into the 18% one, because it's only once off that you get the 25,000 tax-free from you. So the first time you withdraw, you will get that. I don't know if that answers the question, but I saw the hand was up again. I don't know if they're able to indicate if we answered the question.
I see Ramatu says thanks. So covered. I have a hand. So I'm just going to allow Gerald's mic. Gerald, if you could unmute yourself, please.
Yes, thank you. If you can hear me, and then thanks, Zaakir, for your informative presentation. Zaakir, I hear you say that if a member leaves employment, his benefit is regarded as a paid-up benefit and no further contributions could be made. Now, in an industry fund, a bargaining council sectorial fund, so you get employers, like in our instance, there's about 300 participating employers that operates within the scope of the bargaining council. So if you leave employment from one employer and then again employment in the same industry, for the purpose of preservation, our rules provide for continuity, that if you get employment within 3 months, you're regarded as if you have never terminated your services, and your contributions from the new employer gets credited to your fund credit. So is this in conflict with the provisions of the Act, or is bargaining councils can apply for an exemptions, or how could we allow this to continue in the interest of members?
Sure, thanks. Tando, do you want to give it a step?
as I understand the question, is the question, Gerald, about whether after the member leaves the employment, right, of one employer in the same industry. I'm just trying just to rehearse the question so that I understand it clearly. He leaves the employment of the current employer. He's employed within the same industry, and I think I've seen those rules there. I think the municipal funds have similar rules that you are deemed to still be in the employ if you stay within the industry, right? And therefore you're not entitled to withdraw. All right.
Yeah.
And the default position in the default regs, because they are default per definition. In other words, you leave the employer if you do not give a notice of withdrawal that you want to withdraw. As a matter of course, your benefit remains in the fund, right?
Yeah.
So it will not, if anything, it will complement the rules that prevail in your industry to the extent that the member has opted not to notify the fund with the intention to withdraw.
Yes.
Does that address your question?
Yes, that's perfect. So the question is that in our instance, where there's an industry fund, whether if an employee leaves an employer and joins an employer that operates within the same scope of the bargaining council, that's not considered to, I mean, his benefit is not considered to be regarded as a paid up benefit if he has no intention of withdrawing his benefit.
In other words, the implication that it will have is for purposes of not being a paid up benefit. You saying that you will continue to make contributions on top of the contribution, but will it be transferred to the member to another fund that he becomes a member of by virtue of changing employment?
Yeah. So for the period that he's unemployed, there will be no contributions. It means that when he resumes employment, that he will start to contribute to the fund credit that he had through the previous employer.
But I thought you said he changed employment, not that he lost employment.
No. Okay. So what I was saying, I was saying that there's 300 participating employers in the industry. So he leaves one participating employee that is participating in the industry fund, and he joins another new employer, and that new employer operates within the scope of the bargaining council. So the bargaining council is like a industry fund, where it provides for retirement benefits for members that in the industry. So what I'm saying, my question was that if he leaves one employer and joins another employer that falls within the ambit of the bargaining council, that his benefits when he leaves the first employer, that he's allowed to start contributing when he starts employment with another employer that falls within the same industry, so that when he leaves the first employer, his benefit is not regarded as a paid up benefit.
No, of course, and maybe Zarina will come in there because I said if you do not opt to leave, to take out your withdrawal, which in this case you can't because your rules just are prohibited. So when you join another employer and your rules permit that, then the new employer will pay on top of the existing contributions in the former employment or membership that is attributable to the former employer. I wonder if Zarina could come in there, please.
Yes, and I hope, Jedel, that I'm not adding to any confusion and that we do give you what you want. But as Tando has already indicated, with some bargaining council funds or sectoral determination funds, you have that rule of even if someone leaves employment, their employment terminates for whatever reason, they won't generally necessarily get their money within the first 6 months in the event that they join another employer within that industry or within that sector. So that then the new employer within the sector simply continues payment, and that member remains in that fund as if he's, never lost employment, so to speak. So even though the employment has terminated, you remain in that fund, and your benefit the contributions continue being paid So that obviously it ensures, I think at the end of it, that you have a decent benefit, whether it's a withdrawal or hopefully one aims, of course, for retirement benefits. But Gerald, I don't know if that answers your question or if it's not getting, if we're not getting to where you want us to be. So Gerald, maybe over to you. Thanks.
Yeah, Zarina, thank you. It gives me some comfort because, it is my thinking as well that it'll be in conflict with the, the spirit of preservation that when Zaakir mentioned that if a member leaves employment, his benefit is regarded as a paid up benefit and he cannot contribute. But from what I hear is that there are some exceptions and the rules that we have to allow for membership or contributions to resume once the member re-enters employment. But I think for the purpose of today, I don't want to labor it. I think the question has been answered, and thank you for your responses.
Thank you so much, Gerald, for that question. I see Tando. Oh no, Tando has put his hand down, and I'm just checking in the chat box. There is a question from Pumlani. If you buy any annuity, then you die. What will happen to your benefits? Zaakir, if you would like to attend to that question.
So in the later chapters, I think in default regs, they will go into that. But with a life annuity, if you die, you don't get money back or you can't go anywhere. With a living annuity, if there's capital left when you die, that will go to your nominees per what you've written. So it depends what type of annuity you've bought. The other thing is once you buy a life annuity, you give the money over, you cannot get it back. Where with a living annuity, if you buy a living annuity, you can actually convert that to a life annuity at a later stage if you want, but the opposite is not true. So a life annuity, if you die there, the money will go to them. Obviously, there's bells and whistles and ways about where you can get a joint life annuity where if you die, it will pay still to your spouse until they die in a certain amount. But as you load the annuity more, the more expensive it becomes, or the less money you will start getting. So again, this is not to go into Tando, I see your hand is up. May I go ahead?
No, after you, Zaakir, after you.
Sure. So there's different. I mean, the term annuity is used so wide. You got what you call a retirement annuity, and that is a private pension fund, and then you get annuitization, and then you get life, and then you get living annuity, and then you get what you call a hybrid annuity also. So that's a discussion for another day. But when you're dealing with annuities, it's important to read the fine print and understand what the annuity is, what's the basis of the contract underlying the actual annuity. Hopefully I've answered your question.
Thank you,
Thanks.
Zaakir. And I'll now just hand over to Tando to add to Zakir's response.
Oh, yes, Ansha. Zaakir spoke also about in-fund annuitants who do not leave the fund to purchase an annuity outside of the fund. So those are members of the fund. So if they should die, 37C will apply to them because they are still in the fund. And my understanding is that there's moves to amend the position in terms of the coffee bill. I'm not sure, but the current position as it prevails is that if you die as a fund annuitant, 37C will affect the distribution of your benefit. Thanks, Sanj.
Thank you, Tando, for that clarity. The next question is from, Zarina, you have your hand up if you'd like to add as well.
No. Please take the other questions first. I just wanted to add to what Tando had said, Sancho. Maybe if I may just do it now, if you grant me the indulgence. So Tando, you're absolutely right in terms of the consequential amendments to COFI. The position will change because it basically provides that Section 37C won't apply to the annuitants. And that the nominees that has been nominated by the annuitant will then receive the benefit. But I think I think Tando has correctly articulated, Sancha, the current position, but the position going forward is somewhat different. Thanks.
Thank you so much, Zarina. Lou Babalo says that we need another session or recording and slides of this presentation. It's very informative. We will be having sessions again next year, and the recordings as well as the presentations and the question bank will be made available after the workshops are done. Thank you. And then Nomonde. Can a member take more than a third of their benefit on retirement? Zaakir, if you'd like to respond to that.
Sorry, what was the question? Can a member take more than a third in cash, I assume, is the question, the full question.
Yes, I also assume it is that more than a third of their benefit on
Sure.
retirement.
No. Unless it is less than 247,500. That de minimis.
The minimus, yes. Thank you so much,
Sure.
Zaakir. William has a question. If the retirement age is 63 as per the rules and members take early retirement at 60 years, what is the most tax efficient way to treat this? In other words, should the member continue to leave the funds and not withdraw, or should they transfer the whole amount into a preservation fund?
I think that Enoos
Zarina?
going to say we don't give advice. We're not.
Zarina.
That's what she's going. Sure, Zarina.
No, sorry, you've seen my response already, and you know what I'd say. But Zaakir, yeah, that's what I was going to say.
Sure. So look, we don't, again, this is just an informative session or information sharing session. We are not giving advice in what we're doing here today. We are not registered as phase reps, but there are ways, and the question can be answered. And I would imagine a phase representative or certified financial planner will be able to assist you with answering that question. Thanks.
Thank you, Zaakir and Zarina. Alet has a question. Is the bargaining fund registered under the Pension Funds Act or under the Labour Relations Act? Zaakir?
Under the Pension Funds
Or
Act.
Tando?
Sorry. Sorry.
Yes, Tando?
Under the Pension Funds Act.
Thank you, Tando. So Alet is covered. Gladman has a bit of a long question. What is the implication of withdrawing from a retirement annuity fund in terms of, I think that should be access to your funds due to reasons such as lack of growth? Are you forced to pay a penalty for withdrawal, or can you take the full amount to another fund? If you pay a penalty, can you take the money out? Should a penalty be applicable if you ask the fund to transfer to another fund? Zaakir or Tando, if you'd like to respond to that question.
I'll start with this one. Firstly, with the retirement annuity fund, you can't withdraw before 55 in the main, right? So that is, even if there's low growth, you can't take that money out. It's not payable to you. What you can do is you can transfer it to another RA fund. And I think that's where we're talking about penalties and but you cannot withdraw. You can transfer it. Tando, do you want to come in with regard to penalties and the workings around that?
No, Zaakir, I have to be honest. I'm not versed with causal event charges that I think they were dogging the industry back when we were the adjudicator as to whether they still apply. On Zarina can assist me. I must be honest. I as I understand it, causal event charges were done away with. I'm not sure if in its entirety, and I know I'm speaking the presence of experts in that area, but it's not within my fingertips.
Sure. Zarina?
Yeah, so I'm not actually entirely following this, but I think Zaakir, I think that you started with a good starting point. So with the retirement annuity fund, and at least, as the legislation currently stands, you cannot withdraw any amount before the age of 55. So I don't know what penalties would be applicable. Generally, with the underwritten funds, even if there are transfers now, remember the Act doesn't distinguish if we look at I think it's section 14.7, if I'm not mistaken, if there are transfers, you know, you ought not to pay a penalty. So I think the short answer is that you ought not to pay a penalty, Gladman, you know, if you do a section 14 transfer, but you can't withdraw from the retirement annuity fund before you're 55, but you can certainly transfer to another retirement annuity fund.
Thank you, Zarina and Tando and Zaakir, for that.
Sorry, Sancha, if I may just, sorry, you're a bit faint. Can I continue or? Okay. Yeah, no, just briefly. I was just also going to say that there does appear to be more of a shift, you know, and these underwritten funds that we used to have, which caused, as Tando now wants to give away my age, you know, when I was around with the causal event charges, you know, which we dealt with, I think, when I was at the Pension Funds Adjudicator's office under the adjudicator Vuyan Galwana. That's related to underwritten RA retirement annuity funds, but now there's been quite a shift to unit-based funds. Yeah, you know, so, but where they are lingering, so like I said, most funds now are unit-based, so the penalties won't apply. But you do have probably, you know, a handful of, I don't know what to call it, legacy funds, but that are still underwritten RA funds where penalties may still apply. So I hope that that is a more comprehensive answer for, I forget the name now. Sancha, please help me. But the gentleman who asked the question. Yes.
Thank you so much, Zarina. There's a question from Greg. Zarina, are you a tax advisor? Zarina?
Sorry, no. I'm saying we're not tax advisors.
I think it was a typo. No. She meant to say we're not tax advisors.
Oh, did I say we are? Sorry, we are certainly. Oh, let me type that in. Okay, thanks.
Thanks, Zarina. Reggie has a follow-up on a previous question. I know there was a question if bargaining councils are registered under the Pension Funds Act or under the Labour Relations Act, and Tando said no. Reggie's saying, I'm sure that bargaining councils are registered under the Labour Relations Act. Tando, would you like to respond to that?
I meant funds, Sancha, not bargaining councils. If the question was talking about bargaining councils, then I wouldn't have said that. I thought bargaining council funds, like Gerald is coming from, are registered under the Pension Funds Act. That's what I meant. I'm sorry.
Thank you, Tando, for that distinction. I think, oh, I have a hand. It's Patrick. Let me just enable your mic. Patrick, please unmute yourself.
Good morning, ladies and gentlemen, again.
Morning,
Yes,
Patrick.
I just want to find out in terms of the text. Yeah, can you hear me?
Yes, we can hear you now.
Hello?
Patrick,
Okay,
we can
I
hear
just want
you.
to find out in terms of the text, it says 0 to 25,000 will be tax-free. Say in a case whereby you've got 225,000, does it mean that they'll only tax the 200,000 and then they won't tax the 25,000? I don't know if
Sure.
yeah.
Sure. Thanks,
Okay.
thanks, Patrick. So the first point you go to is, did you take any withdrawals previously in your lifetime? So for this example, we'll assume no, you worked at a fund, and this is the first time you're taking a withdrawal. If this is the first time you're taking a withdrawal, then yes, 25,000 will be tax-free, and the 200,000 will be taxed according to that sliding scale or progressive scale. Hopefully that answers your question.
Yes, I'm covered. No, yeah,
Sure.
Answered. Yeah, thanks. Sure.
Thank you so much, Patrick, and thank you, Zaakir. I don't see any more questions. So I think we've come to the end of this workshop quite early. I'm glad we didn't keep you here for a long time on a Friday. I just want to really say thank you to everyone for attending this session and for participating. We really do appreciate it. Thank you to the presenters and the moderators for your valuable inputs. I hope everyone found this workshop today, informative and insightful. And I just really want to thank everyone for attending today. If you, like I said again, if you would like to be invited to day 3 and 4, if you'd like to receive that invitation, please pop me an email and I'll forward you the meeting invitation. There's one last question. If you don't mind, if we can please take Enoch's question. Hi, Enoch, you can unmute yourself.
It's fine now, ne?
Yes, we can hear you, Enoch.
Okay. Yeah, maybe I'm just asking because there is a lot of things that you are talking about here. So some maybe you have to refer them to the other people. So it's possible maybe to get a manual book for this one. Maybe we can check and remind ourselves what happened lately, because some of the issues we hear them, some so we'll forget, and we have to explain to the people when they ask ourselves what happened on this training, what happened on the workshop, what happening in the taxes, a lot of things that has happened lately. So I just maybe ask if maybe we can get a manual book if possible.
Thank you, Enoch, for that question. I think I'm going to let Zaakir go first.
Sure. Thank you, Enoch. And I think the position of, or I would say this is obviously based on the new Trustee Toolkit that we're going to launch in next year. So all the presentations we've done is based on what we call a body of knowledge, or there is a text of where all this information comes from. So what will happen is that will be translated into a e-learning module. So all the information here will be put into an e-learning model. And I think the takeaway for me is, for some of these questions that popped up here, is for us to put it in that, perhaps try and put it into the e-learning module, so that it will be frequently asked questions that you will get when you are studying to do the new toolkit. It will be part of the content, because obviously doing it now and then eventually doing the actual assessment in next year when it's launched is very far away. But remember, this is just scratching the surface with regard to the content, but all of this will be in modules. So as I think this is module 4, whatever the module's number is, this will be module 4 eventually, and there'll be content or that you look at, or e-learning that takes you through it, and then the assessment thereafter. Thanks. I don't know if Zarina wants to add to that.
Thank you, Zaakir, for that. I just want to add.
So yes,
sorry, Enoch?
Yeah, no.
Okay, I just want to add to what Zaakir said. Yes, we will have a body of knowledge which will be made available to trustees when we launch next year. I will also be making the presentations and the recordings available, as well as we spoke about a question bank, where I'm just taking all the questions that have been asked, and I will make sure that each and every one of them are attended to, and that will also be made available. And as Zaakir said, we might include some of them in the frequently asked questions for the new toolkit next year. And thank you. That's it for today. Thank you again for your participation. And I just want to hand over to Zarina to close this session for us. Thank you.
So, Sancha, I don't even know what to add in light of what you've said, apart from saying to our colleagues who were presenters, Tebogo and Zaakir, thank you very much. Both your sessions were incredibly informative. And I'd also like to thank the trustees, principal officers, and our other colleagues who have attended the session. It's immensely appreciated. And, I hope that you found it as riveting as we did. We enjoyed the interaction on both days. We've enjoyed it on this day as well. And we look forward to seeing you at day 3 of our workshop. Thanks so much and have a wonderful weekend. Bye-bye.